Dr. Babasaheb Ambedkar Open University.
My dear friends, let's talk about the second part in our discussion on accounting equation. We've already seen that the accounting equation or the balance sheet equation, which is also known as the bookkeeping equation, is assets is equal to capital plus liabilities. Now, in accounting, whenever there are transactions, we debit one account, we credit another account. This is called double entry bookkeeping system. In double entry bookkeeping system, there will be at least two accounts which will be affected by any transaction, and the debit effect will always be equal to the credit effect. Now, how to decide which account is to be debited and which account is to be credited? For that, we have certain rules of accounting. These rules may be expressed in different manners. In this part of our discussion, we will talk about these rules of debit and credit based on the accounting equation, namely assets is equal to capital plus liabilities. Let's look at these rules first, and once you understand these rules, my dear friends, it will be very easy for you to understand the transaction and give an accounting effect thereof. The first rule is computation of accounting equation is based on rules of debit and credit, which are as follows. The first rule now, any increase on the left hand side of equation is debit. Now, left hand side is, you can look this equation in this slide, A is equal to C plus L, and I have already told to you here A means assets, C is equal to capital, L is liabilities. The first rule says any increase in the left hand side of the equation is debit. Left hand side, asset. Increase in asset is equal to debit. We had seen an example in the earlier part that if an owner brings capital of rupees 20,000, he brings cash into the business. So cash is what? Asset. You had zero cash balance, and now in the business, the cash balance, which is an asset, which increases. Therefore, which account should be debited? Cash account should be debited. The asset is cash. Cash would be debited. Now, in this very case, we will look at some other rules and we will understand which account should be credited. Your next rule is any decrease in left hand side of equation is credit. Any decrease. This is, if you remember only one rule, your job is done. It is a natural corollary that an increase on the left hand side is your asset, is debit. So, if increase in asset is debit, naturally decrease in asset would be credit. There is no decrease in cash, therefore cash is not credited in the transaction that we have seen. So, the account to be debited is cash account because the asset or the cash increases. Let's look at third rule. Any increase on the right hand side of the equation is credit. Any increase on the right hand side of the equation is credit. Now look, when we brought cash of rupees 20,000 by way of capital, does your capital or liability increase? That is the right hand side. Yes, the capital increases. The capital before bringing in, suppose it was 0 and it is a newly started business entity, then the capital increases by 20,000. Therefore, capital will be credited, and your equation matches. A is equal to C plus L. Your liability L is 0. A is asset 20,000. C is capital 20,000. Your liability is 0. And this equation is always equal. Let's also look at the next rule. Any decrease on the right hand side of the equation is debit. This is also a natural corollary. You need not remember all these four rules, my dear friends. If you understand that increase in asset is debit, the rest of the things will automatically follow. Opposite to asset is liability. So, increase in asset if it is debit, increase in liability should be what? Increase in liability should be credit. So you need to remember only one thing, or even if you, initially you may take help of all these 4 rules to enable you to understand which account will be debited, which account will be credited. In the next part of our discussion, we are going to look at, with the help of some examples, and understand thoroughly these rules or the application of these rules. Now, let's look at, before we go into details of the transactions, let's look at the types of accounts. And if you understand the types of accounts and the rules also, we will see later certain rules based on the types of accounts, then also your job would become easier in understanding this accounting equation. The analysis of various transactions helps one to apply the rules of debit and credit. This rule depends upon the nature of account, and therefore before we apply the rules, we need to understand the nature of different types of accounts. For this purpose, all the accounts that we could have in the accounting, we are dividing them into mainly 5 parts. 1, asset account. And friends, I have already told to you what an asset means. An asset is those possessions or advantages a business has on which some money value can be placed. You also need to remember that if money value cannot be placed, it is not recorded in the accounts. There could be certain valuable items with you, but if money value cannot be assigned, if it cannot be measured in terms of money, we do not record them into accounting. And therefore you need to keep these aspects also in mind. For example, you could have employees who are very powerful, who are very sincere, they are very honest, they are very hardworking. But can you measure in terms of money what is the worth or the money value of these hardworking workforce that you have? The sincere workforce that you have? You cannot. If you cannot, you will not record them in accounts. But yes, if you can measure anything, any asset or liability for that matter, in terms of money, friends, you can always record them into the accounting. The second type of account is liabilities account. We have already discussed what liabilities means, and I'll give you some of the examples so that your concept becomes clear. We had already discussed that liability is the money owing to people outside the business. For example, amount payable to bank if you have taken bank loan. If you have borrowed money from our friends and relatives, the amount payable to them. If you have taken certain goods or purchased certain asset on credit, the amount payable to those creditors or the persons who have given you credit, that they are all your liabilities. That's the money you owe to others. The third one is capital account. And capital account, we have discussed, is net worth or the money which the business entity has to pay to the owners. It is brought by way of capital by the owners. The fourth type of the account that we are now going to discuss is revenue or income account. Friends, as I told you, in business enterprise, you are meant there, your objective is to make profit. And for the purpose of making profit, you have started your enterprise. It could be a manufacturing entity where you manufacture certain goods to sell them out to somebody. It could be a trading entity where you buy and sell certain goods, or it could be a service providing entity or an enterprise which provides certain services and earns money. In any of the activity, whether you are into service industry or you are into trading business or you are into manufacturing business, your ultimate goal or the objective is profit. It is not necessary that you always make profit. You might end up losing money also. But while you are doing business, whatever income you get is known as revenue or income account. I'll give you some examples of the revenue. For example, when you sell goods or services, the revenue or sales revenue that you generate is known as revenue. You earn interest on your investment. You get commission. You get charges for your services which you are providing to outsiders. These are all your incomes or the revenues. And for them we will study different rules. The next type of account, my dear friends, is expenses or loss account. While you are doing a business, you need to incur so many expenses, or you incur loss also. For example, you have a stock of goods in which you are dealing in. It is destroyed by fire, it is a loss. Which are the expenses you are incurring? You may be paying salary expenses, you may be paying rent, you may pay electricity charges, you may pay insurance, you may pay wages, you may pay what variety of expenses for running the business. So broadly, these 5 types of accounts, if you keep them in mind, we will learn the accounting rules relating to these 5 types of account in our next part of discussion. Expenses or losses you need to incur. You need to spend money while you do business. For example, if you want the assistance from so many employees, you need to pay them salaries, which is your expense. But all these expenses you are incurring for the business, usually they are meant for generating revenue. For example, you are into service industry and you are providing repairs and maintenance service. For providing this service, you need a mechanic. You need the assistance, the person who would carry out the repairs and maintenance service, unlike a proprietary small concern. If you are a business entity which employs so many people, it will have incur so many expenses on salaries, wages, on establishment expenses like your office rent, office expenses, etc. These all expenses are necessary for you to generate revenue from your repairs and maintenance services that you may be providing. Or you are doing a trading business. In trading business also, you need to buy certain goods to sell them out. So when you purchase goods, that is also your expense. When you incur certain expenses like telephone bills, rent, salaries, etc., these are all your expenses. And then at the end of it, an accounting period, you try to find out what is your total revenue and what are your total expenses. If your total revenue, my dear friends, if they exceed your total expenses, you made profit. And as I told you, your income equation or profitability equation is like revenue minus expenses is equal to profit. But if your expenses are more than your revenue, instead of profit you will have loss. So when you apply this equation, revenue minus expenses, you will have a negative figure. So a negative profit is also known as loss, or is popularly known as loss. And my dear friends, once you have these clear fundamentals of what is profit or loss, please note that these profit or loss will ultimately go where? It goes to the owners. Owners means capital. So any profit or loss that you make in a business enterprise ultimately is being transferred to the capital account. So if you make profit, your capital increases because it is credited to the capital account. Your capital increases and is credited to capital account. If you incur any loss in the business, your capital is reduced to that extent, and therefore your basic accounting equation that we had seen in the first part is asset is equal to capital plus liability always matches. If you incur loss, your capital would go down. Please remember, if you make profit, your capital goes up or your capital increases, because any profit or loss ultimately belongs to the owners, and therefore such profit or loss is transferred to capital account. And therefore some authors say we have only one basic accounting equation, that is asset is equal to capital plus liabilities. But if you want to, any business enterprise would also periodically be interested in finding out what is the profit or loss of a business enterprise, and therefore they are preparing a profit and loss account also. But that profit, because it is being transferred to capital, your basic balance sheet equation or accounting equation, that is assets is equal to capital plus liabilities, would always remain true. This is the end of this part of discussion. Friends, I thank you very much, and in the next part we will be discussing again about certain golden rules of accounting, as well as the rules for different types of accounts, and thereby try to understand again the concept of accounting equation in a better manner. Thank you very much.
Dr. Babasaheb Ambedkar Open University.